Turn our attention to the oil market. Joining us now from our studio in London for further insight is Dave Ernsberger. He's Global Director for Oil at Platts. A very good afternoon to you.
Hi.
We're seeing oil now hovering just near that 120, and that Iran situation seeming to be holding up the oil price. What's going on?
Yeah, there are two things happening today. One, as you mentioned, Iran over the weekend declared that it was going to stop supplying crude oil to Britain and France, two of its European customers, in advance of the EU ban that will come into place on all Iranian imports in July. Iran acting preemptively there, and that's certainly put a little bit of a wind under the wings of the oil market. But secondly, and also importantly, there has been some movement forward on the European Union's attempts to underwrite Greek debt, or at least rescue Greece from completely and utterly falling apart. They've agreed a package that by 2020 could cut Greek debt to something closer to where it's supposed to be. So the market is responding to a slightly better outlook for the European economy and some fear over what Iran is messaging to the market over the weekend.
Can Iran afford, though, to cut production to those countries that it's mentioned?
Well, Iran is engaged in largely a diplomatic debate at this point. It's not talking about cutting production. What it is talking about is taking its 500,000 barrels a day that it sells to Europe and finding alternative markets for that crude oil. So they under their plan, Iran would continue to produce at its current rates and simply find new markets for its crude. And principally, it's been targeting China, South Korea, India, already customers of Iran, and looking to those countries to take more of its oil. And the oil market being one giant bucket of oil, that means that other people's oil would probably come to Europe instead. So for now, it's kind of a little bit about shuffling pieces around on a chessboard, but the noises are unsettling for people.
One of the things that we've heard with commodities is that we could see a technical correction because we have been having this bull run. Do you think that's going to happen?
Well, it's certainly a possibility. You know, when you look deeper into some of the statistics that are being talked around the market, largely in analysis of the Iranian situation, the European Commission yesterday declared that it had enough crude oil in stock to cover crude oil and refined products in stock to cover at least 120 odd days, maybe more, of oil demand, assuming that all imports were cut off. And what that tells you is that the oil market is amply stocked. There's plenty of inventory available to offset a disruption in supply, whether it's a Strait of Hormuz closure, whether it's a Iranian export cut, although that hasn't been talked about, as I mentioned, but even in that situation. So yes, there's a possibility of a correction because the markets are well stocked and well supplied right now.
Let's talk a little bit about Nigeria here on the African continent. Not a dominant player, but quite a significant one. How do you think all this is going to affect its supply of oil in terms of if, for instance, Iran did go through with some of the threats that it's come up with? What would that mean for a supplier like Nigeria?
Well, Nigeria is a preferred supplier of crude oil into Northwest Europe. Already, most European importers are keen to get as much Nigerian crude oil as they can. For the moment, though, Spain, Italy, and Greece, which are the countries that would be most affected by an Iranian export cut, I mean, Britain and France is a sideshow, but those three countries, they're looking right now to closer to home. Libya has got more production coming to market, but Nigeria is a preferred partner. So most of these countries are hoping that Nigerian supplies can stabilize and grow. You know, Nigeria hasn't been producing at anything like the capacity it had in place 5 years ago, and the hope of the European consumer market is that Nigeria can stabilize the situation and lift its production progressively in the next couple of years. So there's an opportunity in the market for Nigeria to expand its partnership as a supplier to Northwest Europe because of what's going on here.
One of the things that's happened, Dave, with this Eurozone crisis, and we saw it as well when we were in that recession, a lot of focus on currencies. And one of the things that Iran said when we had oil hovering at around $147 to $150 a barrel, Iran had come out and said that one of the problems that it had when it came to the oil markets was that oil was bought and sold, pretty much traded on the US dollar. And there have been some conversation that's happened on that. And Iran was actually proposing that perhaps we should change the currency in which we trade with oil. What's your take on that argument?
Yeah, it's an interesting one, isn't it? You know, when the U.S. dollar was having the beginnings of its serious problems about 3 or 4 years ago, just immediately after the financial crisis of 2008, that's when that talk of moving off the dollar became loudest. But in the meantime, every other currency has gone through some sort of serious crisis. There's genuine concern as to whether the euro, which has been talked about as the most likely alternative, whether that would even exist in a year or two from now. Now, obviously, you know, you would assume that it would still exist, but the existential crisis of the euro and concerns that the yuan could be revalued aggressively in the next few years mean that neither the euro nor the yuan of China are really alternatives that everybody can agree upon for now. So it looks like for exports of crude oil, the dollar is going to be dominant for some time to come.
There was a proposal, though, an oil analyst that I spoke to earlier, and he was saying that there had been a proposal, which he thought was absolutely ridiculous at the time, and there was a proposal to come up with a currency that would be a combination of the euro, the sterling, the Chinese yuan, and the Japanese yen, and the dollar not featuring in this currency. And he was saying it would be quite difficult because then the countries that would get this currency, what would they do with it? Because they wouldn't be able to spend it in their own countries. Do you think that could be an alternative, though?
Well, that idea always sounded to me like having monopoly money in return for your oil. So I'm with your analyst there. I think it's the kind of idea that most exporters would probably say, no, thank you. Can you imagine getting paid in a currency that was a composite of the yen, the yuan, the euro, the dollar, and something else? I can't imagine how awful that would be from a risk management point of view. It's hard enough understanding the risk underlying the euro. So I think basically the dollar is a known entity. It may not be the most popular entity and it may not be there forever, but for now, at least you know what you're getting with the greenback. That other thing sounds like a nightmare.
Dave, I want to ask you about the Yusan. You said you haven't heard about it yet, but Total coming out and saying that they're going to start producing this next month in Nigeria, and you haven't heard about this. So if we haven't heard so much about it, do you think that the market is going to take notice of this as a new development in Nigeria?
I think the market always sits up and pays attention to new Nigerian crude sources. I haven't heard about it myself, but that you shouldn't read anything into that necessarily. I don't necessarily have all of the new crude streams at my fingertips. It's just one of those things. But typically with a new crude oil, what tends to happen is the market will go through a period of time trying to run that crude oil through a refinery. Crude ultimately is only useful to all of us when it can be put through a refinery and turned into gasoline and so on. So it typically will go through a period of experimentation. Refiners will try and use it and see how it runs. And then after that, it'll probably start trading at around a market price. So the market's always interested in new streams of crude oil, and I'm sure that somebody somewhere is going to be looking to take advantage of that new supply and find a market for it.